Our first topic is on the accounts. I will be discussing the rules for debiting and crediting the different account categories. I want to give you a brief overview on how the different topics are all connected first. Right now, we will be covering debits and credits, which will be used to journalize transactions in the journal, which is the next topic. After we journalize, we will then post to the ledger. After all transactions for a period of time have been posted to the ledger, we will prepare a trial balance. We will cover each of these topics individually and in more detail, but I do want to give you a brief explanation of each before moving on to this first topic. The journal will list every transaction that the business has. The ledger lists the exact same transactions, but separates the transactions by account. For example, the journal might have an entry showing that we bought supplies by paying cash. The ledger will then show the balance for the cash account and a balance for the supplies account separately. Each account has its own page, so to speak. The trial balance totals the balances of all accounts. Debits must equal credits, so we will know if we made a mistake or if we are on the right track. Let's talk about the individual accounts first. An account is the record of increases and decreases for a specific asset, liability, equity, revenue, or expense account. These are all categories that we learned last chapter. As a reminder, here are some examples of accounts. Cash is the name of an account, and it happens to be an asset type of an account. Supplies is also an asset. Service revenue is a revenue account. Rent expense is an expense account, and equipment is an asset account. An account name is not assets or liabilities. Those are just types of accounts. The specific account name, such as equipment, is an account. If you wanted to know how much cash you have, you would probably pull up your bank account. It's important to have an understanding of the account names and which category each one belongs to. Each category or type of an account will have a different rule regarding debits and credits, which we will learn next. We will begin our discussion on debits and credits by first looking at a T account. A T account represents a ledger account, which we have not gone over yet, but it's the balance of that account. It will show the effects of transactions. For example, a T account for cash will increase when we earn money and decrease when we spend money, just like a bank account. A T account is not required, but is very helpful. This is an optional tool that we can use. I know many bookkeepers who use T accounts for every transaction, some who never use T accounts, and some who only use it for more complex transactions. This is what a T account looks like. Notice that it's in the shape of a T, hence the name. Debits represent the left side of an account, while credits represent the right side of an account. Forget everything you already know about what debits and credits mean because it means something different in accounting. It does not mean positive or negative. In accounting, the definitions are merely just left and right side. We will use double entry accounting, meaning that every transaction affects at least two accounts. One account will get a debit while another gets a credit. Debits and credits will always equal. If they don't, it means you did something incorrectly. The normal balance of each account type will be the positive side. We will discuss this next. But as an example, assets have a normal balance of a debit. This means that the positive side is the debit side. Assets will increase as a debit, decrease as a credit. Here we have the accounting equation, assets equals liabilities plus equity. I also have three separate T accounts representing these three categories. Normally when we do a T account, we will have the account name listed above it, not the category name, but this is just a representation on how debits and credits work for each of these different types. As I explained in the last slide, assets have debit balances. This means that the normal or positive side of an asset account is the debit side. If this were a T account for cash, it would be debited whenever we receive cash and credited whenever we spend cash. Another example could be furniture. If we purchase furniture for cash, the cash account will decrease because we're spending cash as a credit, while the asset account of furniture will increase as a debit because we now have furniture. If we get an asset, it will increase. If we sell it, use it, or dispose of it, it will decrease. Next, we have the liability accounts. Liabilities work the opposite of assets. The normal balance or positive side of a liability is the credit side. Remember, liabilities are our debts. If our debts increase, it will be a credit. If our debt goes away, most likely by paying it off, it will decrease as a debit. For example, you swipe your credit card, you are now in debt. Your credit card balance, which is a liability, now increases. It would be a credit. If you pay off your credit card with next month's bill, that liability will be reduced as a debit. It will go away. Lastly, we have the equity accounts, but I will discuss this in more detail on the next slide. Equity has a positive balance on the credit side. If there is a debit balance, it means it's negative. Let's look at the accounts that affect equity to better understand this one. This equity section is comprised of owner's capital, owner's withdrawals, revenues, and expenses. First, owner's capital has a credit balance, meaning it increases on the credit side. If the owner contributes cash or other assets to the business, their capital account will get credited. Now, if the owner withdraws money from the business, we're not going to debit capital. Instead, we are going to debit the owner's withdrawal account. We have one account for when the owner contributes to the business, which is capital, and another when the owner withdraws from the business, which is the withdrawals account. For right now, you should not be debiting capital or crediting withdrawals. We also have the revenue and expense accounts, which will increase and decrease the equity section. Revenues increase on the credit side. Anytime we make a sale, we will credit revenue. Can we have negative revenues? No. So you should not be debiting revenues anytime soon. As I stated before, in a later chapter, we will close accounts, so we will debit it, but for now, I should not be seeing any revenue debits. Expenses increase on the debit side. If our business pays the rent this month, the rent expense account will increase by that amount as a debit. For now, you should not be crediting any expense accounts because we do not have negative expenses. Like I said, in the future, we will be able to do this. It is very important to have these two slides memorized. There's a great mnemonic I found that helps with the memorization of the normal balances. It is the word dealer, D-E-A-L-E-R. Split in half. The DEA stands for drawings, which means withdrawals, expenses, and assets. Drawings and withdrawals are the same thing. These all have debit balances. The second half, which is LER, which stands for liabilities, equity, and revenues, which all have credit balances. So a good trick is to memorize the word dealer, D-E-A-L-E-R. Debits are positive, credits are positive.